Welcome to Getting Rich with Rich. I'm Rich, founder of Under the Radar Report. Today I want to talk about something that's close to my heart, which I really do try and practice, and that is taking the stress out of investing. Life is stressful enough without you getting stressed about stocks and about returns. I want to take the stress out. So this is the one to watch. I'm going to talk about Nanosonics, one of our favorites. I'm going to talk about the big banks, and I'm going to talk about the big miners. So first up, I cannot go past the big banks. When I saw NAB fall 20% over the past few weeks, I thought to myself, this is a buying opportunity. This is a quality stock, a quality company on sale. Basically, I've made good money from NAB over the years. NAB has been one of my favorite of the banks because it was one of the most improved banks, and it was a well-run bank, and basically, trading at a big discount to CBA. Now after the fall, it compares to CBA's 15% fall, but it's even better value, 5.2, 5.3% yield. I mean, fully franked, what's not to like? Because what's happened with many of these big companies is, as I talked about last week, they have been beneficiaries of momentum. So momentum through ETFs and other momentum funds feeding off those ETFs have just been buying willy-nilly, ignoring fundamentals. So these stocks that were expensive, my reasoning thought, well, now it's gone the other way. And now it's really cheap. But then I looked at it and I looked at the financials closely and I thought, well, while NAB is a good bank, it's not immune to really big headwinds that are facing the sector. Not only costs higher, but it's going to be much harder for this bank to grow. The lending is slowing to a standstill. What else? The capital adequacy rules are only going to get tighter. So I thought to myself, well, it's a quality company, but I don't see any reason to jump in now. Certainly not to jump in to get kind of a full portfolio weighting. This is where I come back to what we've been advising members to do. I mean, read Building Wealth, our $500 strategy, our introductory course. Basically, dollar cost averaging is your way to get access to the banks because it reduces your entry price. It means consistent buying and reduces your entry price. So it's a very good way to build up your core portfolio. This brings me to my second big topic, resources, the big miners. Well, I mean, the big miners are another pillar of the ASX. I mean, this is a sector where three of the biggest players in the world, the three leading players, certainly in iron ore, are Australian. Rio Tinto, BHP, Fortescue Metals. Where else can you see Australia command such leadership? This is a sector that really does benefit from industrialization, from manufacturing, from the building blocks of society. You cannot go past investing in mining. But the question is, what price? Well, arguably, I think BHP is great value at the moment because of its copper exposure. But either way, a way to get access to these behemoths is, once again, dollar cost averaging. And I urge you to read our blue chip report this week because we do talk about the sensitivity of copper and how that can really supercharge BHP's earnings. Hasn't in the last quarter, but let me tell you, copper is on the rise. Another big beneficiary, South 32. Check out our report. So what we've established is that really taking the pressure off by, not worrying about buying and selling for those big core positions is important, and dollar cost averaging can achieve that. So you don't think about it, you just have it automatic debits in your bank account. Every three months, every 6 months, it's up to you. This is one way to build up your core portfolio for a period of time. But what do you do with those stocks that are more volatile? Those stocks that have greater uncertainty? Well, my answer here to reduce your anxiety, to enable you to be as relaxed as me, is take those profits. Take your profits. So our discipline here at Under the Radar Report is take your costs out and let your profits run. One stock we did last month was Nanosonics. Now, Nanosonics has had a huge value appreciation in recent months, but we've been in it for the long term. So I took the opportunity when we'd more than doubled our money to take our costs out. But then what happens? Yesterday, the company announces that it got de novo approval for its Chorus product. So basically, its endoscope cleaning product got sort of first stages of approval in the big US market, and the stock spikes 15%. So we sold out at around 470, went back to 430. Now it's trading around $5. So, okay, we have access to these profits. So we haven't sold out. We're still making money. We're still making money from this profit growth, but I've taken my stress out. So let me tell you about Chorus, okay? So that's, on the one hand, I feel more relaxed, but let me tell you about Chorus. Well, Chorus cleans endoscopes. Endoscopes are complex instruments. Trophons, which is Nanosonics' bread and butter business, is a cleaner of probes. Probes are much easier to clean. So that's one factor. The other factor is the company's just saying, oh, we're just getting up to speed on telling our customers about, the benefits of Chorus and how it can clean endoscopes. Basically, what that means is they've got a lot of work to do. They're right at the first stage of the life cycle of Chorus business, of the endoscope cleaning business. So there's a lot of risk. So I'm not saying it's not worth, $5 a share. What I'm saying is there's a lot of hype in the stock, and we need to take a step back and do our research. And there's always opportunities in small caps to buy in. Like, if you've seen the price of Nanosonics, you will know that there has been multiple opportunities to buy into this growth story. And what we've done is take some risk off the table so we can kick back for a bit and just relax and let management do the hard work that they're good at. What we're about here at Under the Radar Report is reducing your worries like I try and reduce my worries. Taking profits helps me do this. So our aim for members is for them not to worry about investing, not to worry about thinking about entry points, about investment timing. No one gets that right. What we're doing is building wealth for the long term. That's our long-term approach, and it's designed to build wealth and reduce stress. That's what Under the Radar is all about. That's why I'm so relaxed. Talk to you next time.